Stop listening to AI stock analysts. Seriously, if you are buying the AI stocks everyone says are safe, you are walking into a trap that could cost you half of your portfolio. Here is the counterintuitive truth that Wall Street doesn't want you to understand. The same AI revolution that is making a few stocks explode is quietly killing others. And the stocks you think are recession-proof? They are the most vulnerable right now. Let me break down 5 AI stocks that just got major analyst revisions, upgrades, downgrades, and a $3,000 price target that nobody is talking about. I'll admit something. A few years ago, I made the same mistake most retail investors make. I bought the safe stock, the one everyone said was recession-proof, the one with the biggest brand name, and I watched it bleed while smaller, riskier stocks printed money. That experience taught me something crucial. In AI investing, safety is a mirage. Today, I'm going to show you exactly what the smart money is doing right now. Which stocks to buy, which stocks to sell, and most importantly, why. Stay until the end, because the 3 secrets I'm about to reveal will change how you look at every AI stock from now on. Let's start with the biggest opportunity on this list. SanDisk, ticker SNDK. Bernstein just raised their price target to $1,250 from $1,000. But here's the kicker. Their blue sky case? $3,000. That is 250% upside from current levels. Why is Wall Street sleeping on this? Because of fear. Google recently unveiled TurboQuant, a memory compression algorithm. The market panicked. Everyone thought this would destroy NAND demand. SanDisk stock dropped 19%. The counterintuitive truth? Bernstein says those fears are overdone. TurboQuant targets HBM, high bandwidth memory used for AI inference. It has almost nothing to do with NAND's core business, storage and AI infrastructure. Here is what the market is missing. NAND prices only started rising 6 to 7 months ago. The industry is still structurally undersupplied. We are in the early innings of this growth cycle. Bernstein estimates SanDisk's third-quarter earnings per share at $14.18. Fourth quarter, $25.30. The street is at $18.78. In their bull case, where NAND prices rise 75% for 2 quarters, fiscal year 2027 earnings per share hits $224. That's the $3,000 valuation at a 13 times multiple. The trade. SanDisk is trading at just 9 times forward earnings. Historically, during up cycles, it trades at 10 to 13 times. The market doesn't believe the cycle is sustainable. Bernstein thinks the market is wrong. Verdict, opportunity. Next up, Texas Instruments, ticker TXN. Stifel just upgraded TXN to buy and raised their target to $250 from $215. Here is what most people don't understand about AI. Everyone is focused on NVIDIA, on the chips that run AI models. But nobody is talking about the chips that power the infrastructure, the counterintuitive truth. Texas Instruments is the pick-and-shovel play of the AI era. After 6 years of massive capital spending, Stifel says TXN is about to see a free cash flow inflection. Gross capital expenditures are declining, from $2.39 billion in 2026 to $2.20 billion in 2027. Free cash flow per share is projected to rise from $8.13 in 2026 to $10.61 in 2028. But here is the real story. Data center revenue. Right now, data center is only 9% of TXN's sales. Stifel projects that to hit 20% by 2029, growing at 35% annually. Why? Power management chips are becoming a bottleneck for AI infrastructure, just like component shortages earlier in 2026. TXN is solving this with their 300mm domestic capacity expansion. And the CHIPS Act? The investment tax credit just got raised to 35%. Total projected benefits: $1.55 billion in 2026. The trade: TXN is transitioning to 300mm wafers, targeting over 80% of revenue on that process by 2030. That could add up to 800 basis points to gross margins. Verdict: opportunity. And now, the trap: ServiceNow, ticker now. This is the stock everyone thought was AI safe, the one analysts recommended as a defensive play. UBS just downgraded it to neutral and slashed their price target from $170 to $100. That is a 41% cut. Why? Because ServiceNow was UBS's only buy-rated application software stock. Their entire thesis was based on AI resilience. That thesis just collapsed. Here are the 3 red flags from customer conversations. 1. While no one wants to replace ServiceNow, customers are now using AI to custom-build workflow automation. They don't need to buy as many seats. 2. Customer support, which is 10% of ServiceNow's revenue, is the #1 target for AI-driven headcount reduction. Fewer support agents means fewer ServiceNow seats. 3. UBS heard zero consistent buy-in for ServiceNow at the agent orchestration layer. The AI agent layer? Competitors are winning. The counterintuitive truth? AI is not a tailwind for every software company. For seat-based models like ServiceNow, AI is a headwind. UBS now expects skinnier than normal beats in coming quarters. They cut their CRPO growth estimates from 20% to 16%. The trade: the stock has already derated to 15 times 2026 free cash flow. But UBS says that doesn't matter when the core thesis is broken. Verdict: trap. Avoid. Now for the comeback story. Datadog, ticker DDOG. Guggenheim just upgraded Datadog to buy with a $175 price target. Here's the problem everyone knows about. Datadog's largest customer is OpenAI, and OpenAI plans to migrate off the platform completely. That sounds like a death sentence, right? The counterintuitive truth? The migration is taking way longer than expected. That gives Datadog time to build its AI customer base elsewhere, and they already have. Guggenheim believes an 8-figure deal announced last quarter, the largest new customer in company history, is with Anthropic. Anthropic, the $60 billion AI company that is OpenAI's biggest competitor. Datadog now has over 650 AI-native customers. Guggenheim projects those customers, excluding OpenAI, will grow 220% year over year, adding roughly $160 million in revenue. Total 2026 revenue growth? Guggenheim projects 27%, 6% above consensus. And by 2028, they estimate Anthropic's ARR on Datadog could exceed $350 million. The trade: Guggenheim says Datadog's purpose-built storage and query engines, Monocle and Husky, are a deep moat that competitors can't replicate. Plus, their Bits AI suite is category-leading. Verdict: opportunity. And finally, another trap: GitLab, ticker GTLB. Guggenheim just downgraded GitLab to neutral and removed their $50 price target. Same problem as ServiceNow? Actually, it's worse. GitLab has a seat-based model. You pay per user. But AI coding tools are getting so good that developers can write more code with fewer humans. Or the same humans write way more code without buying more seats. The counterintuitive truth? GitLab doesn't monetize incremental usage, only tier upgrades. So if AI makes developers 3 times more productive, GitLab sees 0 revenue increase. The numbers prove this. Net revenue retention has collapsed from 133% in fiscal year 2024 to 118% in fiscal year 2026. Guggenheim expects it to hit 113% in fiscal year 2027, below management's own 115% target. Management has admitted that over 30% of ARR is under stress. 20% from price-sensitive SMB customers, 12% from the public sector. And their new Duo agent platform, a credit-based model, limited customer interest. 70% of revenue comes from self-managed customers who can't even access it. The trade? This is a structural problem, not a temporary one. Avoid until they fix their monetization model. Verdict: trap, avoid. Let me leave you with the 3 secrets that connect everything we just discussed. Secret number 1, the productivity paradox. AI makes developers and workers more productive. That sounds good for everyone, right? Wrong. For seat-based software companies, ServiceNow, GitLab, productivity gains mean fewer seats sold. AI is a headwind, not a tailwind. Secret number 2, the infrastructure bottleneck. Everyone is chasing the sexy AI stocks, the models, the applications. But the real money is in the boring stuff. Power management chips, like Texas Instruments. Storage, like SanDisk. Observability, like Datadog. The picks and shovels of AI. Secret number 3, the fear premium. SanDisk dropped 19% on Google's TurboQuant news. The market panicked, but Bernstein looked at the data and said the fear was overdone. That's where the opportunity is. When the crowd panics on headlines, the smart money buys on fundamentals. So here is my question for you. Which safe AI stock are you never buying again after today? ServiceNow? GitLab? Or do you disagree with me? Drop your answer in the comments. I read every single one. Like and subscribe if you want to stay ahead of Wall Street. I'll see you in the next video.